In 1996, Linda Hartman was 27 years old and working as a nurse in suburban Ohio. At the time, she had $700 saved, barely enough to cover 2 months of rent and expenses. But what she didn't have was a credit score. Not a bad score. No score at all. That changed the day she walked into a local department store for a one-day-only 15% discount if she signed up for a store credit card. Linda didn't think twice. She gave her social security number, her income, her address. The approval was instant. No paperwork, no questions. She walked out with a plastic card and a $2,000 credit line she hadn't asked for. Within 6 months, Linda owed $1.730, more than 1/3 of her annual take-home pay, on that card. Even as the minimum payment seemed manageable at just $34 a month. And that's when her story stopped being unique. Because what happened to Linda didn't just happen to her, it happened to tens of millions of Americans. Then, and right now, maybe even to you. What you probably don't realize is that behind each tap, swipe, and sign, there's a hidden machine, one designed not for your convenience, but for your perpetual debt. I've spent the last 4 months reading through court documents, poring over regulatory filings, interviewing former credit industry insiders, and dissecting lawsuits from coast to coast. What I found will change how you see every credit card offer that lands in your mailbox, and maybe even the way you spend money. Because if you carry even a single credit card in your wallet, you need to hear this. The secret history of the credit card is not a story of innovation. It's a story of psychological warfare, corporate profit, and the systematic design of debt. And the truth is, the credit card industry doesn't just want you to owe them. They need you to. But how did we get here? To a world where the average American household owes over $500 on credit cards, paying interest rates that would be illegal in other forms of lending. Where a product marketed as financial freedom has quietly, over decades, become a trap. Let's rewind. The year is 1958. Bank of America, a regional bank based in California, launches the Bank Americard in Fresno. It's the first mass mailing of unsolicited credit cards in history, 60 $1 pieces of plastic, each preloaded with $500 in credit, sent to people who never asked for them. The result, chaos, fraud, theft, and delinquency rates soared. But more important than the fraud was the data. People used the cards. They spent more, and they paid back, eventually, and with interest. Within a decade, nearly every major U.S. bank was in the game. They merged, adapted, and rebranded. Bank Americard became Visa. Interbank Card Association became MasterCharge, later MasterCard. By the late 1970s, credit cards were everywhere. But here's where the story takes its first sinister turn. In 1978, a Supreme Court case, Marquette National Bank V's, First of Omaha Service Corp., changed everything. The court ruled that national banks could charge the highest interest rate allowed in their home state, regardless of where the customer lived. Suddenly, banks flocked to states like South Dakota and Delaware, which had no usury laws, meaning no limits on how much they could charge you in interest. Let's pause. Imagine you're a young professional in 1980. You get a credit card offer in the mail. The interest rate? 19.8%. You think, I'll just pay it off every month. But then you have a bad month, an emergency. Maybe you're laid off. Suddenly that 19.8% is on $1,200, not $0. And the fine print? Back then, it was barely regulated. You think you're responsible. You think you're in control. But are you? Fast forward to 2001. The dot-com bubble bursts. American households are more dependent on credit than ever. Enter Joseph Sanders, 35 years old, living in Boston. He's got a good job, a family, and $180,000 in mortgage and student loans. Then his wife is diagnosed with cancer. Medical bills pile up. Joseph turns to credit cards just to keep the lights on, to buy groceries, to bridge the gaps between insurance payments. Within a year, he has $22, $800 spread across 6 cards. The minimum payments seem low, but the balances never shrink. He starts getting convenience checks in the mail, advance cash offers at 0% for 6 months. What he doesn't see? After 6 months, the rate jumps to 29.9%, retroactive to the first dollar. This is not a mistake. This is by design. You see, the credit card industry has spent decades perfecting one thing: the art of profitable debt. Let's break down how the system really works. First, there's the illusion of choice. You think you're picking a card for the points, the travel rewards, the cash back. But behind the scenes, nearly all major cards are issued by just a few banks. Chase, Citi, Bank of America, Capital One, Synchrony. These banks compete not for your business, but for your debt. The real profit isn't in people who pay their bills in full every month. The industry term for these people is deadbeats. That's right. The people who use credit cards responsibly are the least profitable customers. The real money comes from revolvers, those who carry a balance month after month. In 2018, American credit card companies earned over $113 billion in interest and fees. More than 2/3 of that came from people carrying balances, not from transaction fees or merchant charges. But the psychology goes deeper. Let's look at the minimum payment. It feels manageable, just 2% of the balance. But that number isn't designed to help you. It's designed to keep you paying indefinitely. Industry studies have shown that when the minimum payment is set low, people pay less, even if they can afford more. And the interest compounds. A $1,000 balance at 20% interest, making only minimum payments, will take you over 17 years to pay off, and you'll pay nearly $4,000 in interest. Why would banks set it up this way? Because every dollar you don't pay off is a dollar they can charge interest on. And the incentives don't stop there. Let's talk about fees, late fees, over-limit fees, balance transfer fees, cash advance fees. In 2009 alone, U.S. cardholders paid $20.5 billion in penalty fees. That's more than the entire GDP of Iceland that year. The system is precise. If you miss a payment, even by 1 day, your interest rate can jump overnight. This is called universal default. Suddenly, your 12% card becomes a 29% card. And if you have other cards, those issuers might raise your rates too, just because you missed a payment elsewhere. It's a domino effect engineered into the system, and all of this is legal. Why? Because the industry spent hundreds of millions lobbying Congress. In the early 2000s, as bankruptcies soared, banks pushed for the Bankruptcy Abuse Prevention and Consumer Protection Act. It made it harder for individuals to get out from under credit card debt, even in bankruptcy. But that's just the mechanics. The real genius of the credit card industry is psychological. Think about the language. Available credit, rewards points, cash back. It all feels positive, empowering, but it's a smokescreen. In 2014, a study at MIT found that people spend up to 100% more when using credit cards compared to cash. Why? Because the pain of payment is delayed. You're not handing over bills, you're just swiping or tapping, or even just clicking confirm online. The money feels abstract, and the industry knows this. That's why credit cards are designed to be frictionless, to make spending easier, not harder, to separate the act of buying from the act of paying. Here's another tactic. Teaser rates. 0% APR for 12 months. It sounds like free money. But if you don't pay off the entire balance by the end of the promotional period, you pay interest on the entire amount, sometimes retroactively. And the offers are targeted. If you've missed a payment elsewhere, you get more offers, not less, because the system knows you're likely to slip up again. Let's return to Linda Hartman. By 1998, she'd maxed out 2 more cards, one from Sears, one from a local gas station. The minimum payments were eating up 1/3 of her paycheck. The anxiety was constant, but every time she started to make a dent in her balances, the banks would increase her credit limits. Congratulations, the letters would say. we've increased your buying power. What they didn't say, we've increased your potential for profit to us. Pattern interrupt. You might think, that would never happen to me. I'm careful. I pay attention. But the statistics don't lie. In 2019, even before the pandemic, 55% of American credit card holders carried a balance most months. The average interest rate, 17.39%. After 2022, with rates rising, that average topped 21%, higher than at any point in history. Let's go behind the curtain. In 2007, a whistleblower named Robert Manning, a former credit card executive turned an academic, testified before Congress. He revealed that card issuers use sophisticated algorithms to find customers most likely to revolve balances, and then targeted them with offers. The industry called these people revolvers, transactors, and, yes, deadbeats. Manning described internal memos where issuers discussed how to maximize revenue per account by encouraging customers to make minimum payments, not pay in full. But it goes even deeper. Every time you use a credit card, you're not just borrowing money. You're creating data. Data about where you shop, what you buy, when you're most likely to make a purchase. And that data is sold to marketers, used to target you with ever more personalized offers. Ever wonder why you get special, pre-approved offers right after booking a vacation or making a big purchase? It's not a coincidence. The system feeds on your spending, and it's watching you. Pattern interrupt. Maybe you're thinking, okay, but I always pay off my card. I'm getting the points. I'm winning. Are you? Because the system is built to catch you the one time you slip. A late payment, an unexpected bill, an emergency. Suddenly, the rewards are wiped out by a single month's interest. In 2016, the average household with credit card debt paid $292 in interest alone, far more than any typical rewards program could ever return. And what about the fine print? A 2018 audit found that the average credit card agreement was over 5,000 words long, longer than Shakespeare's Macbeth. Legal jargon, subclauses, exceptions. It's not written for your understanding. It's written for legal protection and for your confusion. Let's look at another case. Marcus Lee, a 42-year-old engineer in Texas. In 2015, Marcus transferred $8,000 from a high-interest card to a new card with a 0% intro rate for 18 months. He made every payment on time until 1 month his autopay failed because his checking account was overdrawn by $6. The card issuer immediately revoked his promotional rate, back-charged 18 months of interest at the default 24.99%, and added a $39 late fee. Overnight, Marcus owed nearly $2,000 in new charges. He called customer service. They told him it's in the terms and conditions. He never missed a payment again, but the damage was done. The system counts on these moments. And if you think regulators are protecting you, think again. After the 2008 financial crisis, Congress passed the Card Act in 2009. It was supposed to crack down on unfair practices, and for a while, it helped. But the industry adapted. They invented new fees, tightened approval for the most vulnerable, and shifted profits to other areas. Annual fees, cash advance charges, rewards program breakage when people don't claim their points. And here's a dirty secret. For every dollar banks lose in unpaid balances, they make several dollars more from interest and fees on the rest. The system is designed so that most customers pay and pay and pay far more than they ever borrow. Pattern interrupt. You probably think you're immune, that you're good with money. But the truth is, the system is built to make you feel that way until you're not. Until the day you're tired, distracted, vulnerable, and then it's too late. The credit card industry is a masterclass in psychological manipulation. They send you mailers with pre-approved in bold, even though approval isn't guaranteed. They use urgent language, limited time offers, reminders that your credit line has increased. They appeal to your sense of identity. You deserve this. You've earned it. you're successful. But behind every message is a calculation. How likely are you to borrow? And how much can they earn before you default? Let's pull back for a moment. If you look at the aggregate numbers, Americans owe over $19 trillion in credit card debt as of 2024. That's more than the GDP of the Netherlands. And banks are earning record profits, over $130 billion a year, mostly from interest and fees. But it's not just about numbers. It's about lives. Linda Hartman eventually declared bankruptcy in 2003. Her credit score was ruined. She couldn't qualify for a car loan, let alone a mortgage, for years. Joseph Sanders? He spent nearly a decade digging out of his $22,000 in card debt, paying back more than $40,000 in total after interest and fees. Marcus Lee? He never used a balance transfer again and stopped using credit cards for anything but emergencies. And yet, the system rolls on. Why? Because as long as credit cards are seen as a rite of passage, a symbol of adulthood, financial freedom, and opportunity, the industry will keep designing new traps, new fees, new features, new ways to make debt invisible until it isn't. Pattern interrupt. So now ask yourself, are you really in control? Or is the card in your wallet programming you to spend, to borrow, to believe you're winning, while the system quietly profits off your trust? And here's the revelation nobody really talks about. The system isn't broken. It's working exactly as intended. Every loophole, every fee, every gotcha moment, it's not a bug. It's a feature. Because the credit card industry's real product isn't convenience or rewards or even credit. It's debt. Your debt. You think you're protected by regulations, by transparency, by your own good intentions. But the numbers don't lie. The average American household with credit card debt will pay tens of thousands in interest over their lifetime. The cards weren't designed to help you build wealth. They were designed to keep you paying indefinitely. So what do you do tomorrow? If you have credit card debt, even a little, take control. Stop using the cards. Make a budget that puts all extra money toward the smallest balance first. What some call the debt snowball. Don't trust the minimum payment. It's there to keep you paying as long as possible. Pay as much as you can, as fast as you can. Call your card issuer and ask for a lower rate. Sometimes they'll give it to you if you're persistent. Consider transferring balances only if you know you can pay it off before the teaser rate ends. And never ever rely on rewards programs to justify spending. The math is always on their side, not yours. Look, I know this sounds harsh, but I've seen what happens when people trust the system. I've seen lives destroyed, retirements delayed, families broken by debt. If you start now, 5 years from today, you could be completely free. No more anxiety, no more traps, no more payments. Just your money working for you. The secret history of the credit card isn't just a story about banks and fees. It's a story about control, who has it and who gives it away. If you found this investigation eye-opening, subscribe to Mind Over Money for more deep dives into the financial system shaping your life. Like the video if you learned something new, and share it with someone who needs to hear the truth. Because in the world of credit cards, knowledge isn't just power, it's survival.